Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial, and let me know if you guys can hear me out there. My microphone was malfunctioning. When I say my microphone was malfunctioning, I'm sure it's actually a user error. Anyway, wanted to say welcome back from the holiday weekend. I hope that everyone had a safe holiday weekend after the shootings that happened at a number of events this year. So anyway, hope you had a happy 4th and it was free of shootings. I did want to talk about a few things going on right now. This last weekend has had actually kind of a lot of positive news regarding the electric vehicle market, particularly in China. The figures released by Tesla late last week, weren't as bad as I was anticipating. And I stated before that this next couple of months could present a pretty good opportunity to get into Tesla stock if you've been sitting on the sidelines. I still think that's going to be the case going forward. But I also wanted to talk a little bit about some developments in crypto markets and talk about how important these are, and talk about how this complicates the picture a little bit for the central banks' plans all around the world in order to combat inflation. So if you know anything about the history of inflation, the various periods that we've gone through, you know that most of those periods, it was supply shock, meaning that there just wasn't enough supply to go around and satisfy demand, that sort of caused a lot of that inflation. And it was exacerbated sometimes by monetary policy. But in particular, in the late 1970s, early 1970s to late 1970s, there were about 72 countries that pegged their currency to the US dollar. And in order to do that, they had to have massive amounts of actual physical dollars in bank accounts to do that. So we're actually facing kind of a similar issue today in regards to stable coins. And central banks around the world know this, and they're attempting to regulate stable coins going forward. Now, they're not explicitly worried about this being a contributing factor to inflation at this point, but I'm sure that's on their minds going forward as they're taking a look at it. And while the Biden administration has issued some executive orders basically stating that they want crypto regulated, they're asking Congress to come up with some sort of regulation regime. The European Union is actually going forward with this, and they have an outline of what they're going to do. So there are some landmark efforts here in legislation that they're trying to push through their parliament, but they are really kind of at the forefront of regulating crypto. And a large part of that, and they're not addressing some of the more controversial parts of crypto, like proof of work. A large part of what they're addressing right now is stable coins. And if you don't know what stable coins are essentially something that's pegged to the dollar or pegged to the euro, and it's there to provide this stable reservoir of value against the sort of floating transactions, meaning a lot of the business is actually done in the crypto world is actually done in stable coins because it has a stable value, right? But I digress here. What's really important, though, is the fact that legislative efforts to regulate this are going forward. So we're looking at new rules in the European Union that are requiring cryptocurrency businesses to operate with a license and mandate that stablecoin issuers with that hold reserves like banks have, and they're going to hold reserves just like bank has. Meaning banks have deposit requirements, meaning if you have $100 loaned out, you must have $6 or $7 on deposit, right? And they need to be able to satisfy anyone that has immediate or short-term demands. So this legislation follows almost 2 years of negotiations with the European Council and Parliament, and it looks like they've agreed on something called markets in crypto assets, and it's a proposal to bring digital asset businesses under this new regulatory framework. And this is really the first time a true regulatory framework is going to be adopted. So it is subject to final approval before it becomes formally adopted. And yeah, so we all know this is a hold on a second here. Do you happen to know what the implications are? That Bitcoin is labeled a commodity while other cryptos get labeled a security. Yeah, so the difference is really going to be in, so not necessarily a commodity is what is being labeled, but it's being labeled as sort of any other asset that you own that is not a security, meaning it's basically in the same class of asset as like a used car. If you bought a used car, and then sold it for more money, you would owe capital gains on that. But there are a lot of other rules and regulations that don't apply. But yeah, so if the other cryptos get labeled a security, then they're subject to oversight from the Securities and Exchange Commission. You're going to see a lot fewer new cryptocurrencies being developed that are traded on the legitimate market. And here's the real issue with that: there actually isn't a way for the SEC to regulate the issuance of new cryptos based on the way cryptocurrencies are marketed out there, other than saying it's illegal, but then they don't have an enforcement mechanism for that. Everything's done in a lot of cases in countries that are outside of U.S. jurisdiction. It's sold to people or marketed to people in the U.S. They're able to, get into that, hopefully participate in some gain, but actually mostly lose money. But they, for anything that's issued in the United States, though, they would be able to regulate that. I think it would really just push that outside of the United States for the most part. But it would really be about the sort of initial coin offering and regulating that. And you're quickly going to see a huge drop off in the number of new coins that are issued, which, by the way, I think I don't think regulation is a great thing in the case of, I think some regulation is going to be good, particularly in the case of stable coins. I think there need to be some rules around how much they have on deposit and how they actually back up those stable coins. What I suspect is that most of these stable coins are going to be end up being backed by bonds and not actually by cash, right? That is how countries that try to maintain parity with the U.S. dollar do that. But mainly the differences are going to be in taxation, and I haven't really thought about this at this point. I could go into this, but it's really speculation. But so Bram says, hello, been a while since I've seen you on my live streams. Elon's saying hi from, I think it was Estonia or Lithuania. And been busy for a while. What's new in the market? Well, I'll tell you, there's a lot of actual really good news coming out of the EV market right now, especially out of China. And BYD, between it hasn't stolen the crown from Tesla in terms of battery only vehicles being sold, but it looks like it's going to relatively soon. And in terms of their total new energy vehicles sold, meaning their hybrids and their battery electric vehicles, it's absolutely going to do that. And the base price for one of their new vehicles that's coming out that has almost a 200-mile range, it's a two-door hatchback. I forget what the name is. It's not the Dolphin. It's the Seal, the BYD Seal. Their base model is going to be $8,000. So it's called the NEDC. It's the NEDC range of close to 200 miles. So you can safely say that it's probably going to have a real range of about 175 miles. But still, an electric vehicle that gets 175 miles per charge, you can charge from 20% to 80% in 18 minutes at $8,000. I think we can safely say that BYD is the first company to have truly worked its way down that value chain into the mass market, and that they are very quickly going to pass up Tesla as the most popular maker of EVs in China. Whether or not they can successfully market overseas and be truly successful overseas, that definitely remains to be seen. Their past vehicles that I've seen in other places were not great. But this was back when they were making gasoline vehicles, or mostly gasoline and diesel vehicles. So I hear very good reports about the BYD Han. I hear very good reports about their other vehicles in the EV lineup. I hear very good reports about their improvements in their manufacturing process. So it isn't necessarily quality that is going to win the war in EVs, meaning it's not quality that's going to determine who becomes the largest seller of especially in this market where most people's, the demand is not satisfiable at this point. Everyone that's selling an EV is selling as many as they can produce. The issue right now is how quickly can these companies produce and what are the bottlenecks? One of the biggest bottlenecks for most EV companies is, of course, batteries. And there are lots of companies that have partnerships with CATL. I know that that's one of the things that is trumpeted by NIO supporters. And let me be clear, no one should really be a NIO supporter or an Xpeng supporter or a Tesla supporter. It is an investment it's not a team, right? You want these companies to do well, but let's be realistic about the partnerships that they make. And I've actually been guilty of this myself in the past, but in particular, when we look at CATL, they are rapidly trying to expand their production capacity all across the world, not just in China. And they're basically pushing themselves to the limit to provide battery cells to everyone. BYD is in the same boat, but they are, I think, they're the fifth largest battery producer in the world at this point, and they have, they can satisfy their own demand first before they go out there and have to sell or start selling batteries to everyone else. So, yeah. So this is interesting. Most people who are Tesla enthusiasts probably know who Sandy Munro is, but there may be some people that don't. If you don't know who Sandy Munro is, he is an older gentleman. He's an engineer that specializes not really in electric vehicles. He specializes in the manufacturing process for the automotive industry. He's a world-renowned expert in the industrialization process and all that, and he reverse engineers a lot of vehicles. And I have not watched that video yet, where he takes apart a Model Y with a 4680 pack. I'm really looking forward to it. But he has actually provided some of the most important insights that I've ever most important insights into the EV industry that I ever was exposed to. So yeah. So on to what's going on right now in the world in terms of and my screen is frozen again. In terms of EVs, let's talk about sales right now. Actually, let's look at this. If it lets me go to this, did Tesla lose the EV crown? Well, the short answer is actually no, but it looks like it's going to happen at this point. And on my live streams, I like to do a little bit of looking at things kind of behind the paywall. This is one of those. If you're part of my Patreon, your Patreon dues go to pay for my access to premier news sources. Unfortunately, my internet connection is not cooperating right now, but let's talk about that. Sales for various EV companies in China have roared back as lockdowns have ended. We're looking at Neos. I think they were they're up pretty high. Let me see here. Yeah, Neos are up pretty high. Xpeng had close to record production. Now, their quarterly production was relatively flat. That had a lot to do with lockdowns. It was flat compared to the quarter before, but they are definitely on the upswing here. Their product line is pretty encompassing for the market that they're targeting. That really sort of middle class market. People who can afford a $30,000 car in that range. Neo's market is a little bit narrower, but we're looking at people that have quite a bit more money. But they are facing quite a few more challenges in terms of supply chain. Neo is not sure why that is in a lot of cases, but the reports that I'm reading, the ones that I'm having translated from Chinese, are basically stating it is a problem with getting raw materials. This is one of the reasons why their production has been low. And of course, they were affected by lockdowns as well. Kind of the big exciting news out of the EV space there, when we're looking at least the folks that are traded here on US exchanges, we're looking at Li Auto introducing a new model last month. Let me see here. Okay. All right. Looks like my internet connection is not going to. So I was wondering, is my screen choppy out there? You guys able to hear me just fine? Because it looks like my internet connection is just not cooperating. So other news here is that the euro dives to a 20-year low against the dollar. Of course, everyone's saying blame Russia, but and the ECB. You're going to have to say that most of that needs to be blamed on the European Central Bank. But let's talk about currency strength. How strong do you actually want your currency to be? The idea that the Federal Reserve has had for the last, 100 years or so is that, okay, so I'm just going to exit this here. Yep. Try to get back to my main screen here and see if I can't. Yeah. All right. Let's talk a little bit here on Li Auto deliveries as soon as this page comes up. And we'll put this in perspective for you. in comparison, and we're going to compare BYD's numbers to Tesla. Yeah. So yeah, the picture is a bit behind, and it's literally I'm not able to pick anything up in terms of get anything from this website, which is Barron's, which is not a great advertisement for their service. They don't sponsor me or anything like that, by the way, guys. This is just a service that I like, but it's not. I don't think it's them. I'm pretty sure it's my connection. Anyway, let's move on from that for the moment until I can get that up. If you guys want to ask questions, I am here to answer any questions. I had an extremely interesting conversation yesterday with a graduate student who's studying alternative battery chemistries, or maybe actually that's a bad way of putting that, alternative energy storage chemistries. And all of his work right now is theoretical with no practical applications. But if there is a practical application for some of these technologies, it's going to change everything. The supply of lithium, or at least not the supply of lithium, but actually the ability to mine it and take it out of the ground and process it, because it doesn't occur in its natural elemental form because it's so highly reactive. Those problems might go away when we're looking. Now, I didn't actually understand all of the chemistry that he was talking about. And it was a little bit above my head, and I had a few drinks. But it was a very interesting conversation. But he kind of opened my eyes up. I went home after that and I looked up some of the stuff that he was talking about. It kind of opened my eyes up to just how much is happening in the world of energy storage and how much this is going to change our lives going forward. It may be that 20 years from now, none of us have a vehicle that is powered by a lithium-ion battery. It may be something completely different. And I started talking to him also about the future prevalence of sodium-ion batteries for less energy-intense applications like cell phones, watches, laptop batteries, tablet batteries, that sort of thing. And he seemed to agree that that's probably going to be the cheapest, safest, and most likely alternative. So, hold on a second. Michael Will says, isn't there a short report stating that they sold 200,000 batteries to itself for its battery swap stations to bump its revenue? So I dug into that short report there, and the number 200,000 was kind of incorrect. So they have like 19,000, and I'm doing this all from memory. So in that report, which I can't remember who did that, and it wasn't a firm that I was really familiar with, but I dug into their numbers a little bit, and it may be that they just recognize revenue a little bit too soon. But the issue was they have 19,000 battery subscriptions, right? It doesn't matter if you have 19,000 battery subscriptions. In order to make sure there's a battery waiting for that client at all times, and to handle growth of that, you're going to need more than 19,000 batteries. The bare minimum you would need with their Gen 1 battery swap stations is about 1.2. That's the bare minimum in a perfect world, where there's a line, there's enough time for each new battery to go in there that recharges, meaning that 5 people pull up and an hour later 5 more people pull up, meaning there's not a line the whole time and you're not changing out a battery every 5 minutes. In a perfect world, you would need 1.2 batteries to satisfy their demand, to make sure there's always one there available, because that station would hold 5 batteries. The newer generation of those, I think they have 13 batteries that are in the version 2, and there's no actual person there that does that. It's all done. It's all done automatically. But even then, you're still, if you're in a high demand area, you're still going to need more than 1.2 batteries, or more than 1.15 batteries in order to satisfy, not 1.2, 1.06 batteries to satisfy that demand. You have to accommodate growth in subscriptions, and you have to accommodate the fact that in some areas there's going to be more usage of more stations and that sort of thing. So it's not a surprise that they have 19,000 subscriptions, and they sold 40,000 batteries to this subsidiary, which is owned by them and another other company. So I've always stated that from the beginning, battery swap is probably not a permanent solution for their market. At some point, they are probably going to either sell that operation or fold that operation into something else. But this is a way, creating subsidiaries like this is a way to limit liability. So the numbers involved in that didn't convince me that there was, sort of fraud by itself on the surface. What it did look like to me is they recognized the revenue from that 40,000 batteries sold ahead of time instead of amortizing it over like the next 7 years or so, which is the supposed lifetime of that battery or whatever rules allow them to do that. They recognized it upfront and then inflated their revenue a little bit. So now NIO has responded by saying there's some inaccuracies. I would like to see a more detailed response on that. But reading through some of the other things in that report too that were concerning is the fact that NIO has chosen to associate themselves with people who have dubious pasts. So yeah, I am not encouraged by that. But no, it was kind of the case where I've looked at a couple of other short reports where the folks are shorting the stock. They stand to gain money if the stock price goes down, and they put out a report out there that is not factually incorrect, but doesn't really doesn't really prove anything. And there's been a number of short reports on EV companies in the last couple of years that were like that. I mean, the greatest one that was actually where everything was actually true is, of course, the one that was done on Nikola Motors, where they kind of ripped apart Trevor Milton and all the claims that they've been making. But that company's still around, to my surprise. NIO, I don't actually think they're going to suffer very badly from this whatsoever. And it looks like they haven't. So, and Bram says that energy storage depends on whether the application is mobile or stationary. That's true. And part of that conversation was the various other methods of energy storage that are not necessarily intuitive now because we're locked into, these batteries that are dependent on metals. It may be something as simple as gravity storage, like pumping water uphill during the day, using solar panels and letting it flow downhill at night and to turn a turbine or something like that. That's really oversimplifying it, but there are a number of other types of energy storage chemistries out there that I wasn't aware of. I actually think that mechanical energy storage, like storing energy in flywheels, storing using gravitational energy, I think those solutions are all going to become more common as we go forward for applications that aren't mobile. These are stationary applications. I think that we may see gravity storage for grid scale level projects become a bit more common as people start getting really creative. But the real point of that comment and that conversation I had was that there's so much going on out there that that no one individual can really keep up with everything that's going on. Like he was talking about some concepts that I was completely unfamiliar with, which I thought was great. I always love stumbling into conversations about technology that I'm completely unfamiliar with, and it was very encouraging. We look at all of the various issues with lithium. And look at all the various issues with lithium, and not just that, but using these metals and batteries to do this. And there may be far different techniques to accomplish this. Any thoughts on Rocket Lab? I don't know a thing about that stock. As you type that in, I was just thinking this is one of those stocks that I don't know anything about. One of these companies I don't know anything about. And if my internet connection cooperates, maybe I can take a look at it here. RKLB Rocket Lab USA. So space is one part of the economy that I really have not invested in at this point. And I've discussed this before, not necessarily on I think I have actually discussed it on live streams. My issue with a lot of these space technologies is they haven't created a clear pathway for profitability. None of these companies have. Particularly Virgin Mobile, they went public probably too early. I don't think they have a strategy or a pathway to profitability anytime soon. And I know they're backed by one of the largest billionaires on the planet, but I think they're actually going to face a number of challenges. I think the Blue Horizon is perhaps in a little bit better condition in terms of what their ultimate aims are. But space technology right now, the main draw is of course government work or tourism, and we haven't found a way to exploit space commercially other than through like communication satellites and things like that. So I think a lot more needs to go on in terms of in terms of developing that market before I start to invest in anything space wise. But I don't actually know what this company does here. Lunar Photon completes its 6th orbit, raises her Yeah. Okay. So this is a company that looks like they've never been profitable. Since 2019, they've had increasing losses, variable revenues. Okay. Now, I mean, for a growth company, that's not terrible. So it's a space company that provides launch service and space system solutions for space and defense industries. The company provides launch services, space engineering, designs. Um, yeah, this is a company that probably won't be on my radar for a while. I may miss an opportunity here to do this, but just like investing in 3D printing in 2012, I think that some of these investments in the space industry may be a little bit early. And if you know anything about my history with investing in 3D printing, you'd know that I was a huge loser investing in that. I got very excited about 3D printing in that time period, about all the different applications. I'm still excited about the technology. I'm just not excited about any of the stock offerings right now that are out there. And I think I may actually still hold the record for the highest price ever paid for 3D shares. Right, that's not a record to be proud of. It was something around like $91 a share is what I bought it for, and I wrote it all the way down to like 40, 41, $42 a share before I sold it. But that's another one of those things where I got so excited about a technology that I didn't really pay attention to the company fundamentals. I didn't really pay attention to what the actual practical applications were, and didn't realize that a lot of it was years and years and years away from being marketed. And I was very skeptical when last year when Nano Dimensions shot up like a rocket. Very, very skeptical about that stock, largely because I dug into their patents and started looking at their actual technology. And at the time, they didn't really have a lot of competitors. By the end of the year, when I started investing in it, they had 4 competitors with all of their own patents and technology. I will say that their Dragonfly printer is definitely cooler looking than everyone else's, but it's not less expensive. They don't have a technology lead, and their applications are really limited so long as it's cheaper to actually make printed circuit boards using the older method rather than 3D printing them. So you're really looking at the applications for that being just for prototyping. So it cuts down your time for prototyping. So a company might have a need for one of these machines, at anywhere from 50,000 to $250,000 a pop, depending on which one you buy. They're only going to need one of those to handle all of the prototyping that they need in most cases. And how many companies are actually out there who need to purchase that? And so their strategy is basically to make money with their dielectric ink. And they had this patented dielectric ink. By the end of the year, there were 4 other companies that had a similar product with a similar patented dielectric ink. They have a lot of competition in that space in a limited market at this point. There may be future applications for Nano Dimensions technology that just haven't occurred yet or come into prominence yet. But as of right now, this is not a sector or company that I would invest in, and that's kind of the way I feel about space technology right now. There are so many holes in my knowledge about what's going on in space technology, how that can be exploited by our capitalist system in a way that makes profit for shareholders, that I really can't invest in a company that is involved in not just any space technology or anything like that, but all of the new companies that have come out in the last 2 years. I'm highly skeptical of, particularly because Virgin Galactic, I really feel it doesn't. I'm not saying that it's borderline fraud or anything like that, but they just didn't have any business going public. And I think that the investors who bought that IPO, if they're not already disappointed, they're going to be disappointed for years to come. So there's a lot of buy activity in SWN after that. Is this quarterly rotation, or American natural gas have more potential to rise? So American natural gas definitely has more potential to rise due to global supply chain disruptions, but also because liquid natural gas is going to become more popular, and we're going to be exporting more of it to Europe. It's not just us. Looks like UAE is stepping up their exports. The problem with UAE is that most of their natural gas production is already spoken for, And I was talking to someone else who's kind of a specialist in the industry. They have stepped up production of natural gas. What they're not willing to do is to drop more drills into the ground to do that at this point. But they have stepped up some of their natural gas production, and they're planning to export more to Europe. Everything's fine right now while the weather is warm. The wintertime is really going to tell. So the biggest sign you should be looking for as far as how far companies are really committing to this new natural gas or liquid natural gas boom is you really should be looking at how many of these new liquid gas tanker ships are being produced. And I thought we would already see a lot of these orders go through, and we really haven't. Since the beginning of the Ukraine war, there's only been a few of these ships not commissioned, but where construction has begun on them because there were only a few of them in existence. But there are a couple of different liquid natural gas receiving ports. I think one in Hamburg and one somewhere in Poland that are being have been completed, and a couple of more under construction. So the move away from Russian natural gas for Western Europe is probably permanent. They're going to, and they may, and after the war ends, and at some point it will, you might see Russian natural gas come back into Eastern Europe in particular, but it's not going to be in the volume that it was before. And Western Europe is not going to allow themselves to be held hostage economically hostage by Russian geopolitical interests in the future. They're going to diversify their natural gas supply. So we stand to benefit from that. And Southwestern Energy stands to benefit from that as well as Cheniere Energy and a couple of other companies. I think it's highly unlikely that we lay a natural gas pipeline down from the United States into Europe or something like that. There would be a massive project, and our natural gas supply, even though we are the Saudi Arabia of natural gas in a lot of ways, I hate that comparison, but we are the Saudi Arabia of natural gas in a lot of ways. The supply is not infinite, and we are going to run out at some point. So both us and Europe are going to start looking for alternative solutions, and we have to do it relatively quickly. Sparked Interest says, "Hi, Jay." Hi back, sparked interest. So questions, go ahead with your questions, guys. We can take a look here at NIO, Xpeng, and Li Auto deliveries. They set a record, and that's combined. They set a record. So NIO delivered 12,961 vehicles in June. That's up from 7,024 deliveries in May. June's number marks a monthly record for the company, which is awesome. That's a monthly record. But it also means that in terms of production, both Xpeng and Li have kind of passed them up. And BYD owns that top spot as a Chinese company in terms of EV production. And they've got a lead that I don't think these other companies are going to catch up to. What's more, June results topped guidance when NIO gave its fourth quarter numbers in June, which is a good sign. For the second quarter, NIO delivered 25,059 units. That is down from 25,068 cars delivered in the first quarter. Most of that was due to COVID lockdown and supply chain issues. Second quarter production and deliveries were dented by China's zero COVID policy, which resulted in part shortages and reduced production for the entire industry. That is the entire industry worldwide, not just in China. Li Auto delivered 13,024 vehicles in June, up from 11,496 deliveries in May. It isn't a record, but it's the third best month in the company's history. Monthly deliveries topped June's result in November and December of 2021. So these companies' deliveries are fairly variable. So for the second quarter, Li delivered 28,687 units, down from 31,716 delivered in the first quarter. And a final second quarter tally also topped its own guidance. And Xpeng results look best of all. The company reported 15,295 deliveries, up from 10,125 deliveries in May. Like Li, it's just short of a record, but it's better than expected based on the company's recent guidance. For the second quarter, Xpeng delivered 34,422, almost flat with 34,561 cars delivered in the first quarter. So this number right here for Xpeng is pretty important. Up 15,295. So production capacity, when they say, when you add up the production capacity that Xpeng has, on paper, they have a production capacity in total of about 20,000 units. One of those units, though, the G3, is not selling very well, and that factory does not run at full capacity. Their other units are the ones that are pushing their factories at full capacity, and that unit is made in their facility that's a partnership with Hyma Motors. And I think the total capacity of that plant is about 100,000 units annually. They're not coming close to selling that in the G3. They just aren't. And that was the first vehicle that they produced. And it's their P7 and their P5 units that are selling the most. That are actually they're priced to the right market. They're marketed to the right market, in my opinion. They haven't wasted as much money on. Well, I don't want to say wasted as much money. This is one thing I consistently misunderstand about companies, and that is branding. It's one thing that I consistently underestimate about companies is the power of branding. They're not spending as much money on branding as a company like NIO is. They don't have things like NIO houses, a clothing line, a product line, all that stuff. That all these things that are associated with NIO, they don't do that. And their seller network looks quite a bit different. They also have not focused on battery swapping. They're focused on building out their supercharger network, and they share their supercharger network with all of the other big EV companies that are out there. So those are the big numbers out there for Xpeng. The problem with Xpeng is going to be one of perception. If everything goes well, and by August or September, they deliver 20,000 vehicles, you may be able to push a little bit more production out of those factories, but 20,000 is a theoretical maximum. You can always push a little bit more than the theoretical maximum, but Xpeng probably won't, just because one of their factories, which has a production capacity of about 100,000, is selling one of their least popular models. So at 15,000 deliveries, I don't think that they really break the 18,000 mark before the end of the year when their next factory comes online. And then they may have a fourth factory coming online sometime in late first quarter through second quarter of next year. So they're going to be stuck in terms of delivery growth, and that's going to look bad for investors. It's not bad in the long run. I think it would create an opportunity in that case to start grabbing that company while things, it looks like they're being passed up by some of their competitors in that time space. So they're going to be stuck at right around 18,000 units at least until January of next year. It's going to take a while to ramp up to full capacity at their new plant. And then they have a second plant, which will actually be the fourth plant overall, but second new plant coming online sometime probably around second quarter of next year. But let's talk about, they've completed their first factory in about 15 months, right? Their first smart factory in about 15 months. NIO still has not completed the NIO Park. We don't have any production numbers from NIO Park. I've seen a few suggestions that some cars are rolling out of there. It's not clear that those are vehicles for sale, or if they're just for test at this point, or it's not clear what they're doing when it comes to NIO Park at this point. So I was under the impression that at some point this year we were going to see NIO Park really start to ramp production. That is not happening at this point, and the park was supposed to be finished. At least the manufacturing facilities were supposed to be finished somewhere around April. So I'm a little bit concerned about that. Xpeng, my concern is really more about perception, right? Not about their ability to build factories, their ability to produce cars, and their ability to sell them. It's the fact that they're going to have a production stall until they have new manufacturing capabilities come online, which may give us an opportunity, actually. So, yeah. And George says gold is under 1,800 and Bitcoin is under 20,000. Yes, we are seeing enormous amounts of wealth evaporate in Bitcoin at this point, especially as people trade in panic and lock in those losses. I myself, I didn't have that much Bitcoin, so I'm just kind of riding this storm out. This is another Bitcoin winter. We've seen this before. I don't know how long it's going to last. But since it's not really going to affect my holdings aren't that great, so it's not going to affect my life. I'm not going to panic or anything. So gold being under 1,800 is curious, not to me, but it's going to be curious to people who think that gold is a hedge against inflation. There is not any good evidence that gold is a hedge against inflation, especially when you compare the price of gold and inflation side by side. Gold is an alternative asset. You probably should have some in your portfolio as a hedge, as part of an overall diversified portfolio. You should have some gold holdings, but it is not necessarily a hedge against inflation. Very few things are. Residential real estate is one of those things that is. But I think metals had one of the biggest drops they've had in a really, really long time. I think that was I think I may have seen that kind of on the front page of Yahoo News earlier. Let me go back and check that. But yeah, that is one of those curious things. But it is I understand why people think that this is supposed to be a defensive line during inflation, but they're trading just like the rest of the market. Remember, the market has been democratized to a great degree. It's not simply professionals trading on the market like it was in the 1970s when we saw gold rise kind of in lockstep with inflation. But gold went through really long periods of decline as well. I want to say that between like 1982 and the year 2000, gold pretty much lost money every year. I think it was about 18 years where gold either just barely kept up with inflation or it actually performed poorly in comparison to inflation in that period. And that's because the market got severely messed up by really high government securities or government bond prices in the 1980s, where it looked like a lot better investment to take out a government bond at 13% interest rather than speculate on the price of gold going up. So here you go. This is a good question. Sparked Interest says, are we officially in a recession? So officially, no. You don't get to recognize a recession until after one thing happens, and that is 3 consecutive quarters of declining GDP growth, meaning negative GDP growth. So we could actually be in a recession right now. It is likely that we are in a recession, in my opinion, although the numbers for the first quarter aren't going to come out for a couple of weeks. Yeah, so that's interesting. But remember about recessions, though, it's kind of like once a recession is fully recognized and we're 3 quarters into it, that's pretty much when the market starts to turn around, because people are already starting to look forward to whatever comes next. And I have to admit, I'm already starting to look forward to whatever comes next. I've gotten hammered along with the rest of you guys in my portfolio. My income is actually decreased in this time as well, as people are tightening their spending, and I'm taking less chances in the covered calls that I'm selling, so my income has declined. But I'm hoarding my cash and looking for opportunities here. I wouldn't get too upset at missing out on an opportunity at Roblox at 25. I think it'll be back close to around 30 here pretty soon. All it takes is a little bit of bad news. And Roblox has a long way to go before they really see profitability. They have a clear pathway towards it, but they have a long way. There's going to be a lot more bad news or misperceived news that comes out. So markets are reacting to a choking economy. And I think it's an important headline. And I had this strange conversation also at that same party that I went to with someone who I assume was fairly successful financially, that didn't seem to understand that one of the goals of Fed actions right now is to actually raise unemployment to reduce demand. So they want people to be unemployed, to stay at home and not buy things. They want to slow down the economy. And the way you slow down the economy is by making sure that we have that folks are not out there spending money. They don't want them to not have money. They just want them to not spend money. That's going to give basically reduce pressure on supply lines. It's going to give companies time. Even if we don't reduce pressure on supply lines, eventually people are going to see prices of products are so high that more and more folks are going to get into producing these, acquiring these, or selling these, and competition is going to force prices down at some point, as long as that spigot for free money is turned off. Quantitative tightening is in swing. Basically, $120 billion a month is being taken out of the economy. We have about 20% less spending by the federal government than we did last year. Basically, about $1.2 trillion is going to that won't be added to the economy this year that was last year. That's because of the end of pandemic spending. So a lot of things are going on in the real estate market as well. I did a real estate live stream that very few people watched. There didn't seem to be a lot of interest, but I got a couple hundred views afterwards. And I will say one thing about that. I don't think the real estate market is going to crater. It's just going to look a little bit more normal than it has in the last couple of years. Basically, since 2014 or so, we've been looking at real low inventory in terms of real estate. And we've been looking at really cheap money, and that has pushed prices up. I do expect a correction in real estate. So my house that I've owned since 2014 has basically doubled in value in that time period. There really isn't a reason for it to have doubled in value other than the fact that it was powered by the ability to borrow money really, really cheaply. And I was just looking at the calculation based on where interest rates were at the beginning of December last year and the way they are today. The overall cost to own a home is basically up 65% in some markets. Between price appreciation and interest rate rise, it's up 60. We priced a lot of people out of the market. I'm seeing, especially if you go on TikTok, you'll see a bunch of realtors wandering around at open houses alone. No one's coming to see it. And they're talking about how just 3 months ago, they would get 20 offers in the first couple of hours and the house would be sold. And now houses have been sitting on the markets for 2 weeks without any offers being made. So the market has definitely changed. The seller's market to a degree is ending in lots of places. The concern that I have right now when it comes to housing is the fact that so many hedge funds are looking at inflation and looking at residential housing. And I think I covered this on another live stream. 41% of the homes that were sold in the last, or since the beginning of the year in Austin, Texas, which is a hot market, were bought by institutional investors. We're talking about the Goldman Sachs. We're talking about Morgan Stanley. They were bought up by those institutional investors, and they're not being rented out. So yeah. We see here, opinion on Unity software. Kevin Garcia says, opinion on Unity software. So I am a holder of Unity software stock. I'm underwater on that right now. I bought Unity, and I would probably buy Epic software if they actually, or Epic Games rather, if they went public as well. I did a kind of a deep dive into their developer tools and how they have basically prevented software people who want to develop games from needing to reinvent the wheel over and over and over. They have giant code libraries as well as a 3D platform to build on. I think that Unity software is going to be a great investment, but it's going to be kind of a 10-year type of investment. And I think we should all reduce our expectations for how we expect a stock. I expect this to be a multi-bagger, like a 10-bagger, but over time, not in 2 or 3 years. This is a long-term investment. They've already, and when you look at the number of video games that are being produced and written on Unity's platform, it's absolutely enormous. So yeah. Let me see. This is an interesting question. Sparked interest. I'm going to get to that next. So PK. So how large is sovereign investments in U.S. stock markets versus retail investors? So I'm not sure I understand that question. Do you mean investments by sovereign wealth funds? Do you mean just institutional investors, or do you mean versus retail investors? So there are still far more institutional investors, meaning big companies investing in stocks like pension funds. If pension funds is the big one, of course, and the big money houses like the Morgan Stanleys, the Merrill Lynch's, there's far more of those investors than there are retail investors. But retail investors tend to swing market sentiment more than you think, and those retail and those big institutional investors react to that. Now, in terms of sovereign wealth funds investing in U.S. stock markets, I don't have an answer for that. I'm not sure what that would be, but I would say it's probably a fairly large slice. Most country, and not every country has a sovereign wealth fund, by the way. It's usually countries that have a single resource that they sell that do that. They invest in those sovereign wealth. I mean, think of like United Arab Emirates, Qatar, Saudi Arabia, and a number of other oil producing companies. Those are the big ones that have sovereign wealth funds. But other countries like Norway, which a lot of people don't realize is a single resource country, in a lot of ways. They have a sovereign wealth fund that invests outside of the United States, and a lot of those are outside of Norway into various industries. And a lot of that actually goes to fund the social programs that they have there. But they have a fairly large, I think, yeah, I don't, when it comes to Norway, don't quote me exactly on that. I read an article like 10 years ago on that. So that could be very much outdated at this point. But those other countries have well-known sovereign wealth funds. Like Brunei is another one that has a giant sovereign wealth fund. Just for example, was it at one point, the Saudi Arabian sovereign wealth fund owned about 10% of Uber. I don't know if that's still true, but at one point they did. So I tend not to, I used to be, tend not to invest in things that certain countries that had sovereign wealth funds invested in, but digging deeper into the research, I figured it's actually going to be impossible to do that because they invest in so many different things. So, but the answer is I don't know how much of a slice they take up of the U.S. stock market. So here we go. Sparked interest. This is a good question. I heard you say that the best 10 days are after the worst 10 days. Are they days that happen in consecutive order? No, absolutely not. So the research suggested that the best 10 days of the market usually follow within 10 days of the worst days of the market, right? So a lot of times when you're scared out of the market by a really bad day, you take more than 2 weeks to decide to get back in the market. And at that time, you probably missed one of those 10 best days. Now, it's not happening like clockwork. A lot of times the best day in the market, at least in 2020, happened immediately after the worst day in the market. The market was down 2,000 points one day, up 2,000 points the very next day. So let me see here. Mary W says, I watched your real estate live stream. As a residential market gets tighter, do you think this leaves iBuyers like Open and OPAD to benefit and even in a high rate environment? So they're going to benefit in a high rate environment, but it's going to take a while for the shock to wear off. Think about how long it's been since people paid above 5% for a mortgage. It's been a very, very long time. Now, I have the benefit of age and hindsight here, where I think I've told you guys multiple times, my first home had a 9.5% interest rate on it. And at the time, I thought I was getting a pretty good deal as a young guy that didn't have a lot of credit and had to use some creative financing to buy that home. But some of these strategies are not working out. You saw Zillow actually got hammered in terms of having to dispose of a bunch of real estate at under the prices they bought it for in Arizona. And it really affected their bottom line. So in terms of investments like Open Door, so I'm actually looking at some of these real estate stocks myself to get into these because I think they're actually they're getting justifiably hammered right now. It doesn't mean they're bad companies for the future, but the worst is yet to come for the housing market. So the last person, to some degree, that you should be listening to when it comes to the real estate market is a realtor. And my mom's probably watching this, and she was a realtor, and she knows that I actually have issues with realtors in general, probably because in California, at least, I've never been the buyer going out in the top end of the market. And if you're a buyer that's buying like a normal home or a condo or something like that, you actually don't get treated very well. But not only that, the real estate agents that I've dealt with seem to have one of the largest capacities for self-deception when it comes to the market itself that I've ever seen in my entire life. I did kind of a underground survey of everyone I know in real estate back in April when interest rates started to rise. I'm like, and I asked them a question, and I know the answer to this question because it's just math. I said, so do you think the raise in interest rates is going to affect your business? And to a man and woman, they said, oh, no, we're as busy as ever. And it's because there's no supply. And the company that I work for is able to get listings. To a man, they said that. And to a woman, they said that, not realizing that none of this was the question I asked. I already knew the answer to. And it's just based on math. If the cost to own a home goes up by 65% in a year, you have priced out a lot of people who could afford to buy a median priced home. So the problem is, in the market that I live in Southern California, roughly 13 to 14% of the households in San Diego can afford to buy a median priced home. And that was at prices in April. And I'm sorry, that survey was done in January, right? By April, the cost to own a median price home based on the cost of the mortgage, the interest rate of the mortgage, would have pushed your payment 65% higher. You have cut your market in half, right? So I knew that this was kind of a long tail in terms of outside interest in buying real estate in California, institutional buyers buying real estate, and the bottom dropping out of the retail market. And in that same conversation, these people would tell me, oh, the real estate or the mortgage broker that I work with says that they haven't done any refis since beginning of April, but I'm not worried about the real estate market. Okay. All right. So I'm not worried about the bottom dropping out of it like in 2008, but I'm prepared to lose 20% of the assessed value of my home, meaning that whatever it's valued at now in a year to a year and a half, it's probably going to be worth 20% less. And I'm fine with that, of course, because I live in the home and I'm not trying to sell it or anything like that. I'm also fine with that because I don't, although I don't like being a landlord that much, I wouldn't mind owning another investment property. And I'm thinking about dipping my toes into the Airbnb thing. I don't know if I really want to do that. That might require a lot of work. But yeah, so really take a look at the numbers. Don't even believe me. Look at the numbers and the reports that are coming out locally in your own market. Don't necessarily look at national numbers because all real estate markets are local. They're very localized. But look at the number of price reductions. Look at new homes coming on the market. Look at all this stuff. Right now, we are seeing listings increase, and we're seeing the number of listings increase, and we're seeing the time it takes these homes stay on the market. It's starting to increase as well. At some point, all of the people who aren't blinking at this incredible rise in the amount that it takes to get into a home, at some point, that supply of buyers is going to be exhausted. And the people who could afford a home last year, a median price home last year in your market, now many of them cannot. Like probably half of them can't afford to buy a home now. They're either going to be forced to temper their expectations as far as how much house they can buy, or they're going to be forced to stay in their apartments or rental homes, which provides zero incentive for landlords not to raise rent. And I had this conversation with my tenant this year, and just recently, where I elected voluntarily just not to raise rent, largely because she was put in a situation during the pandemic where she had decreasing income. She never failed to pay me on time. And never failed to pay me on time, never failed to fix things, and just tell me something that she had done and she'd fix and all. She's a great tenant. And I elected just not to raise rent because times are now tough for her and I can afford not to raise rent. And if if the price of everything she needs to buy is going up for gas and groceries as a single mother, I'm going to give her a break. But that is not the case. You're going to see the price to own a home is going up, meaning that your mortgage payments are going up, not the actual price. Prices would have to fall pretty far in order to match how much it costs you to own a home now based on the interest rate that you're paying on a mortgage. It's roughly $500, a little bit more than $500 for every $100,000 of home that you're buying. So if you're buying a $500,000 home, it may cost you up to 20, depending on your credit rate, it may cost you up to $2,500 more per month than it did last year at the same time. So that is pretty stunning, and it's going to take a lot of people out of the market. Sparked interest. Thank you so much for the super chat. Thank you so much. I don't do these for the super chats, but I certainly appreciate it. And you're a frequent person on my live streams here, so thank you so much. So mixed day on the markets in general today. We're looking at the NASDAQ being up 194 points. The Dow is down 129. The S&P is up 6 points. So mixed day on the markets. You might as well just call it flat here. Technology did get a boost, though. Everything that I've looked at in the last couple of weeks was up a little bit, with SoFi being up, Xpeng being up, STEM, wheat futures are down. I'm still paying attention to that. The real test for wheat futures is going to be in the fall, where we find out just how much Ukraine and Russia were able to produce. I don't remember exactly why I looked at QuantumScape. Oh, yeah, Nicola came up in a conversation. I just couldn't believe that they were still around. But I get consistent questions about QuantumScape consistently emailed to me My email is usually at the end of my videos, not on my live streams. I don't want to get too much spam, but I get consistent questions about QuantumScape. My opinion of QuantumScape hasn't changed. They are years away from being able to scale a product, right, at industrial scale. Maybe 2027. You're going to have plenty of opportunity to grab shares of this company at this price, even in the event of a really large market turnaround. I think a lot of people will figure it out that their pathway to profitability is fairly narrow and it's really far away. Based on the technology that they're working on here, I am not sure that by the time they're ready to scale production, that some other technology won't have surpassed that. So I guess most surprising to me has been the recent drop in Square. That is, I own Square stock too, and this is pretty close to my cost basis, but I bought Square years and years and years ago. But back down to pretty much my cost basis in this respect. Square is not a company that has not been profitable. It's not a company that hasn't been growing profits, and it has gotten fairly punished by the market recently. So pretty interesting. So any other questions you guys have? We are coming. Oh, we're actually at the hour right now. I kind of didn't intend on being on this long today. I was trying to keep it at 45 minutes. But if you guys have further questions, let me know. I'll give you guys a minute or two to ask anything. Anything you want to talk about technology, really? Okay, so no, I'm not saying that retail investors move the market more than pension funds and sovereign wealth funds. I'm saying that they can move market sentiment, and a lot of it now has to do with spreading fear through social media. And don't think that just because institutional investors tend to make more rational decisions that they aren't also affected by irrationality as well. You don't know how many people that I spoke to right before Bear Stearns. These guys ran giant funds. They had $100 million, $200 million under management, and one of the guys had $1 billion under management. And all three of these guys were telling me that I needed to jump on this opportunity to invest in Bear Stearns. So it was because they had created this myth of invincibility around Bear Stearns. So yeah, and for a number of different things. But no, I when I say retail investors move the market, I really say it's market sentiment, not the actual price. There just aren't enough retail dollars in the market to move that. But it's the spreading of market sentiment through social media that has me most concerning, probably because I can't measure it. I'm really into numbers, and things that I can't measure I don't like, or I don't, or things that are unexplainable through numbers are hard for me to comprehend. So, if that makes me sound strange, whatever. That's just me. Eric M says I finally bought SoFi and the STNE dip. You see here, the Stone Company Limited dip. Are we talking about the same thing here? Yeah, I think right now I wish I had waited to get into SoFi at this point as well. But I actually did end up buying another 100 shares today. I couldn't resist it at these prices. Anytime it gets below 6, I'm buying. Is the number 6 significant at all? It's not significant at all. This company is not profitable now. They do have growing revenues, but based on current cash flows, you really can't assign a value to it because it's simply not profitable. But when I take a look at the revenue growth of SoFi, I'm still encouraged. I don't really know much about Stone Company Limited here. Okay. So it has come up in research before. I haven't paid that much attention to it. Yeah. This is very interesting. How would you explain the volatility of Tesla? So that's interesting as well, largely because Tesla does not fit under any model based on current cash flows. At no point in its history could you ever say that it was fairly valued based on current cash flows. The idea of investing in Tesla has always been you're investing for something far in the future. And you have to discount your expectations based on the probability of whether or not those predictions are going to happen. And it doesn't help when you have a really outspoken CEO. Now, it wouldn't matter even if if Elon Musk was always measured and thought about what he said, it's the fact that he's quoted so often that affects the share price. I think it's the fact that there's so much coverage of this company that affects the share price. And it's the fact that the price has never matched the fundamentals. I have been an investor in Tesla since 2011. Many people watching my channel have owned Tesla for years and years and years. And if you have owned Tesla for years and years and years, then you go through long periods where you are underwater on your initial purchase, or long periods where the stock is flat, like 6 months to 18 months in a lot of cases. And if you hold on to it, you can be rewarded. If you have an exit point, you can be rewarded. If you don't have a strategy and you don't have patience, it can come back and hurt you. If I had made if I had made purchases of Tesla when it was up at $1,200 a share earlier this year, I might be pretty disappointed. But essentially, buying Tesla anytime under $1,000, I think that if you have patience, the ability to wait for a couple of years, you are going to be richly rewarded for that patience. The problem is a lot of people are doing this on margin. They're a little bit more concerned about the price going down. They probably suffered some margin calls here. Actually, the only people that would have suffered margin calls are people that as long as they didn't have any other margin debt, are folks that bought like north of 1,000. So when Tesla starts going over 1,000, I don't. Well, I'm not buying any more Tesla anyway because it makes up too much of my net worth. But I've been sorely tempted to. But it's already too large a portion of my portfolio, and I actually, when the stock splits, I actually will be forced to start thinking about how I'm going to reduce my shares of Tesla. Not because I don't believe in the company, just because I don't like having more than 10% of my overall net worth tied up in a single asset. It makes me really, oh man. This is a company that I actually did a post on in my Patreon group, but I never made the video, largely because I really couldn't get any information on their AI model. And I made the post on there kind of mostly in generalities. So I think the company is a bit overhyped. I think that what the company really should focus on is cutting the cost to deliver certain types of insurance. They certainly went about it in sort of a disruptive manner as well. They went after a market that really was not well served, and that's renters insurance, and they did it dirt cheap. When it came to other types of insurance, there were some issues with how their AI was working, and I think they were actually accused of having a racist AI, which I don't know. I don't know why. It's the age that we live in, guys. But in terms of company fundamentals, I remain to be convinced when it comes to Lemonade. But it is very curious. I think that a lot of these services. Here's the thing that I think it's going to be completely driven by AI in the future, and that's going to be term insurance. Basically, you're going to get you're going to apply for term life insurance is what I mean. Because it's already so strict right now. They take virtually no chances. A nurse comes out, takes your blood pressure, takes some blood, and if there's anything irregular in it, they say, okay, we're not issuing you at preferred best or whatever their top level is. They drop you down 2 levels and say, now your premium is 40 to 60% higher than you anticipated. There's still a lot of wasted labor. You have to pay nurses a lot. The direction that industry is going to go is this way. You're going to apply online. You're going to get a kit that looks probably a lot like a 23andMe kit, except you're going to draw your own blood. You're going to pee in a cup. You're going to send it off. They're not going to do. You're going to take a picture of yourself and you're going to fill in your height and your weight, and it's all going to be done by AI. And they're going to issue your price. And the cost of insurance is probably going to go dramatically down as they democratize that and they get more people involved. And it is the perfect business to push online, so long as you can use the law of large numbers. You need to be able to market this to as many people as possible, because the way insurance works is by having as many data points as you possibly can to make judgments on that. And that is the next industry that is going to be pushed completely online, where there's going to be virtually no human interaction. There's certainly room to do that with certain types of property and casualty insurance as well. But that's going to be the big moneymaker, because the way term insurance is priced is that 98% of policies are going to expire without being paid out. Some of that happens because, the conditions that cause you to need insurance are gone, or you outlive your term. And the reason it's so cheap is because 98% of those policies expire without being paid out. They only have to pay out on those 2% of the time. And it's not because they're denying your life insurance claim. It's because it's designed only to cover you for a certain period, only if you're already relatively healthy. And it's designed to expire before the end of your life expectancy, or they make it super expensive. And then you won't buy term. You'll buy permanent insurance, which there are few circumstances for the majority of people where permanent insurance actually makes sense. Like, most permanent life insurance policies are sold to most people for mostly the wrong reasons. There are really only a few reasons to buy a permanent life insurance policy. Most of the time, it's just going to end up costing you more than term insurance. You're probably going to cash it in anyway, and you will have lost money over that time period. That's what happens in the vast majority of cases. If you have certain issues, health issues, where you need to convert, it's better to buy a convertible term policy if you actually need to have permanent life insurance because you have health issues later on in life. So buy a policy that's convertible into a permanent policy. And then if you get cancer at age 40, after you've had this term policy for 10 years, you convert it to a permanent policy. So that way you can't outlive the term. It's going to be expensive, though. You're going to pay the cost of insurance at the time, but they won't make you requalify for health reasons. But yeah, so the insurance industry is a multi-billion-dollar industry, and that is one of those things that is being pushed online right now. And I think that Lemonade definitely has a future, but I think that there's a lot of companies that are going to be in that space that are going to have more reach than Lemonade. Okay, so thank you so much for tuning in today. That is all I really had to say. I can't believe I went off on that wild tangent on insurance. I love the insurance industry, but I realize everyone else thinks it's as interesting as watching grass grow. So I won't do that to you guys again. Thank you so much for tuning in today, and I will be back tomorrow at 1 p.m. Thank you so much.